Hey everyone, welcome to WealthTube. Today, we're embarking on an exciting journey into the vast and dynamic world of investing. Join us as we uncover invaluable strategies, insider tips, and expert insights to help you navigate and conquer the path to building and managing your wealth effectively. Every day, investors around the globe trade millions in shares, amounting to billions of dollars. Some invest alone, while others work in teams or use sophisticated computer programs. These factors create a competitive environment for outperforming the market. Despite this challenge, a few manage to consistently succeed. We believe that with the right mindset and strategy, individual investors can also thrive. By setting long-term goals and doing thorough research, you can start your journey towards beating the market. What is the market? When people talk about the market, they usually mean the S&P 500. This index includes 500 of the largest publicly traded companies in the U.S., like Amazon and Apple, as well as less familiar ones like Duke Energy and Edwards Lifesciences. The S&P 500 is so large and diverse that it serves as a stand-in for the overall U.S. economy. Other indexes exist too. The Dow Jones Industrial Average, which tracks 30 large U.S. companies, is popular but has a unique weighting system. The Nasdaq Composite, which includes nearly 3,000 stocks, focuses heavily on technology companies and doesn't represent other major industries like retail and finance. What does beating the market mean? When investors talk about beating the market, they mean getting returns higher than the average market returns over time. Beating the market not only increases your money, but also shows you picked better than average stocks, bonds, or funds. It's important to note that you can lose money and still beat the market. For example, if your portfolio lost 20% in 2008, you would have still beaten the market by 18 percentage points. Conversely, getting positive returns doesn't always mean you beat the market. For instance, an investor who earned 20% in 2013 would be happy but still fall short of the market's 29% return that year. What does the market usually return? If we look back to 1871, the S&P 500 has grown by an average of 9.15% per year. This means that long-term investors have seen their money grow by about 9.15% each year. To see how much this 9.15% return can increase your wealth, imagine you invest $1,000 this year, add $1,000 every year for 40 years, and earn 9.15% per year. After 40 years, you would have $384,000. This means by investing less than $3 per day and doing nothing else, you could end up with hundreds of thousands of dollars. That's the power of compounding. However, there are three important things to keep in mind. 1. The market's historical return of 9.15% includes reinvested dividends. Dividends are payments you get for owning shares of certain companies. Not all stocks pay dividends. Usually, bigger companies do. When dividends are reinvested, they automatically buy more shares. For example, if Apple stock costs $220, you can earn money if the stock price goes up and by getting dividends. Right now, Apple pays 94 cents per share each quarter, or $2.92 per year, which goes into your brokerage account. Even though dividends seem small at first, they add up over time. Without them, the market's historical return is only 4.45% per year. After 40 years, you'd have $110,000 instead of $384,000. 2. We're not accounting for inflation. Prices go up over time. For example, your grandparents could buy a soda for 5 cents, and I went to baseball games for $4 as a kid. Today, those prices seem unreal because of inflation. Over the past 100 years, inflation has averaged 2.82% per year. This means a banana costing $1 today will likely cost $1.03 next year. The S&P 500's 9.15% historical return doesn't consider inflation. So, even if we have $384,000 in 40 years, it won't buy as much as $384,000 today. If we include inflation and dividends, the market's return is 6.96% per year. This means someone saving $1,000 a year will have the equivalent of $211,000 in today's dollars after 40 years, assuming a 2.82% inflation rate. So, their savings will buy as much as $211,000 does today, even if the total amount is $384,000. 3. You must be invested for the long haul to achieve those returns. To achieve good returns, you must invest for the long term. The market is highly unpredictable due to events like wars, recessions, natural disasters, and new technologies, which can greatly affect yearly returns. Since 1871, there have been only 6 years with returns between 8% and 11%. Despite this, the average annual return has been 9.15%. This shows why long-term investing is essential. Short-term investments can result in very high or very low returns, but they tend to balance out over time. Why try to beat the market? You can potentially earn an average of 9.15% per year by investing in an index fund like the SPDR S&P 500 ETF, which aims to match the market's return, minus a small fee. Most people shouldn't try to beat the market because it can lead to significant losses and stress over financial decisions. The 4 simple rules to beating the market. If you want to beat the market, you're competing against other investors and their high-speed trading computers. There's no guaranteed method that works for everyone because if a surefire way to beat the market existed and everyone used it, it would become the new standard. However, there are 4 fundamental principles to follow if you aim to beat the market. 1. Get your financial house in order. You should only be investing when a few very important boxes can be checked off. You have an emergency fund that can cover your basic expenses for 3 to 6 months with no income whatsoever. All your high-interest debt has been paid off. You have money that you definitely won't need in the next 3 to 5 years. Market downturns happen all the time. The only way to make sure you can ride them out is to make sure your basic needs will be met no matter the investing climate. 2. Don't be the market. Diversification brings big benefits. It means spreading your investments across different stocks and industries so you don't risk losing everything if one stock fails. But if your aim is to do better than the overall market, you can't just mimic it. For instance, if your portfolio mostly mirrors the S&P 500, you won't beat its performance. Finding the right balance is key. You don't want a few stocks to make or break your savings. Research shows that historically, only a small fraction of stocks drive most of the market's gains. If you invest more in these winners, you could outperform the market. Everyone tackles this differently. Here's what I do. I let my best-performing stocks grow until they make up 20% to 25% of my portfolio. Stocks I believe in strongly get at least 3% of my total investments. Usually, my top 10 holdings make up about 75% of my stock investments. Remember, I have more than 25 years until retirement, so I can handle market ups and downs. If you're closer to retirement, you might choose safer investments. 3. Don't pay high fees. The fees you pay for investing may seem small at first. A 2% load fee here, a 1% expense ratio there. It doesn't sound like much for a mutual fund, but when you do the math, it adds up quickly. In 2014, a writer shared a story about a family friend with a few $1,000,000 who didn't realize she was paying $30,000 annually in management fees alone. These fees are significant. They can be higher than what you spend on your mortgage, food, travel, clothes, and other expenses. Moreover, fees don't just reduce your savings directly, they also prevent your money from growing over time, especially for younger investors. To keep more of your money working for you, choose funds with no load fees and expense ratios under 1%. If you manage your own investments, watch out for trading fees and taxes, which can also impact your returns. 4. Invest for the long run. Investing for the long term is a smart strategy to save money and reduce taxes. Research companies carefully and buy their stocks gradually to feel comfortable with your investments. Hold on to these stocks for many years. This approach, as David Gardner from Motley Fool suggests, is a powerful way to grow your initial investment many times over. When it comes to beating the market, there's no single guaranteed method. The steps mentioned earlier are just the beginning. You'll need to do your own research and find what works best for you. Remember, famous investors like Warren Buffett and Peter Lynch have different strategies. Buffett focuses on strong companies, while Lynch advises investing in what you know well. Each style suits different personalities. Learn from these approaches, adapt them to your own style, and keep learning. Regardless of your strategy, keep an investment journal to track your decisions and wait before reacting to market news. Review your investments annually to stay informed, but avoid making frequent changes based on short-term trends. Above all, keep your financial goals in mind. Whether it's retirement or funding education, Investing should support your larger life objectives. Thank you so much for watching. Stay tuned for more valuable insights on WealthTube, and don't forget to like, subscribe, and hit the bell icon for notifications on our latest updates. Happy investing!